Hey everyone, welcome back to the channel. Today we're diving into a hot debate in the investing world. Should you invest for growth or for dividend growth? Which strategy builds wealth better, and which is right for you? Let's break it down. Growth investing is about putting your money into companies that are rapidly expanding. Think tech stocks like Tesla, Amazon, or Nvidia. They usually don't pay dividends. Instead, they reinvest profits back into the business to fuel even more growth. Growth investing, on the other hand, focuses on companies that pay regular dividends and, more importantly, increase those dividends consistently over time. Think companies like Johnson & Johnson, Microsoft, or in Australia, Wesfarmers and CSL. So growth investing is like betting on the future. Dividend growth is betting on a business that already produces reliable income and will keep paying you more every year. Here's why so many long-term investors choose dividend growth over pure growth. Reason 1. Growing passive income. Dividend growth stocks give you real cash, regular payments that can grow year after year. That income becomes a powerful source of passive cash flow, especially in retirement. Reason 2. Compound growth plus reinvestment. If you reinvest your dividends, especially using a DRIP dividend reinvestment plan, those dividends buy more shares, which then earn more dividends. That's compounding in action. Reason 3. Psychological stability. During market crashes, growth stocks can plummet, and you're left with nothing but hope. But with dividend growers, even if the stock drops, you're still getting paid. That makes it easier to stay invested. Let's say to investors, start with $10,000. Investor A goes for growth stocks like Amazon and Tesla. Investor B chooses dividend growth stocks like Johnson & Johnson and Procter & Gamble. Over 20 years, growth stocks might outperform in capital appreciation, growing the portfolio to, say, $80,000. Dividend growth stocks might grow to $60,000, but they VA also paid out $25,000 in dividends along the way. And here's the key. Dividend income continues to grow even when the market doesn't. Those cash flows offer flexibility. Reinvest, spend, or use to hedge risk. So while pure growth might win in some bull markets, dividend growth wins on consistency and resilience. Dividend growth stocks often fly under the radar, but they've been silent killers in long-term wealth building. Companies that consistently raise dividends tend to be profitable, financially stable, disciplined with capital. They're less likely to make reckless decisions and more likely to treat shareholders like partners. And over time, a 2% dividend growing at 8% annually turns into something much bigger. Now, I'm not saying growth investing is bad. It can be incredibly rewarding, especially in your 20s and 30s when you're focused on long-term capital appreciation. If you can stomach the volatility and you're okay not getting income now, growth can supercharge your wealth, as long as you can handle the roller coaster. But dividend growth adds something growth stocks usually guarantee: income discipline and risk management. Here's the truth. It doesn't have to be either or. A smart investor might use growth stocks to build wealth in early years, shift towards dividend growth for stability and income as they get closer to retirement, or blend both from the beginning. For the best of both worlds, but if you're someone who values growing income, long-term stability, and compounding power, a dividend growth strategy is hard to beat. If this helped clarify the difference between dividend growth and pure growth investing, drop a like and consider subscribing for more long-term investing content. And let me know in the comments, are you more of a dividend investor, a growth investor, or a mix of both? Thanks for watching, and remember, slow and steady growth with income is often the real secret to wealth. As always, hit that like and subscribe button, and happy investing.